Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're diving into Corebridge Financial's third quarter 2025 results. Now, this one was a real head-scratcher. The company dropped a story with two totally conflicting headlines, a miss on profit but a huge beat on revenue. We're going to unpack how management managed to convince the market to look past the miss and buy into the bigger picture.
So when Corebridge reported on November 4th, investors were looking at two very different numbers, and it created some immediate confusion. Let's take a look at exactly what they saw.
Okay, so on one hand, you've got an 11% miss on earnings per share. That's a headline that almost always gets a stock punished. But then you look to the other side, a massive revenue beat. Over $1 billion above what anyone expected. So you can see the conflict, right? Do you focus on the lower profit, or do you get excited about those surging sales? And we can see the market's confusion play out right here, in real time. Before the market even opened, the stock was selling off on that earnings miss, down over 2%. But by the close, it had completely swung around and finished positive. So clearly, something management said during their call totally flipped the script. What in the world did they say?
Well, management's strategy was pretty clear. They had to shift the focus away from that single EPS number and get investors to look at the underlying strength of the business. They built their entire story around two things: cash flow and controllable growth.
First, they pointed to this number, $12.3 billion in total premiums and deposits. Now, this wasn't just a strong quarter. It was the highest level of sales they've had since the company's IPO. That sends a powerful signal that even with some noise on the margins, the core business engine is absolutely humming. Next up, they showed off the balance sheet. A really formidable $1.8 billion in liquidity at the holding company. This is what you'd call a fortress balance sheet, and it was beefed up by a major reinsurance deal. This gives them immense financial flexibility.
And what are they doing with all that flexibility? They're giving it back to shareholders, aggressively. We're talking $509 million in Q3 alone, with the lion's share of that, $381 million, come in from just buying back their own stock. With the payout ratio around 80% for the year, the message is crystal clear. We generate cash, and we give it back to you. The outgoing CEO, Kevin Hogan, really summed up their whole argument with this quote. He's basically saying, hey, judge us on the fundamentals we can actually control. Our sales, our cash, our buybacks, not on some quarterly accounting noise.
But of course, the analysts on the call weren't just going to take management's word for it. They started digging into the key concerns that were driving all that fear before the market opened. They were asking the tough questions that were on every investor's mind. The first big theme was all about profit margins. Analysts wanted to know what was causing the squeeze on spread yield in their individual retirement segment. It's a critical metric for a company like Corebridge, so it was a really important question. And management's response here was absolutely key to turning that sentiment around. They admitted there was some minor pressure, but then they clarified that a big piece of the decline, 5 basis points, was because of a one-time asset reallocation. The crucial takeaway for everyone on the call was that this was a non-recurring event, and their long-term growth outlook is still totally fine.
Next up, they tackled a hot-button topic for the entire sector, private credit. With all the scary headlines swirling around about risk in this area, investors really needed some reassurance on Corebridge's exposure. And they got that reassurance. The CFO explained that the portfolio is overwhelmingly high quality. Out of $30 billion in private placements, a full 90% of it is investment grade. The higher risk stuff, only about $3.5 billion. This really helped de-risk the whole issue for investors.
And finally, the analysts turned to the elephant in the room. With both the CEO and the CFO announcing they're leaving, what does that mean for the future of a key business like group retirement? It's a fair question about strategy in the middle of a big transition.
And the outgoing CEO was emphatic by calling the group retirement business an extremely valuable strategic asset with an enormous opportunity. He sent a really powerful signal of continuity. The message was clear. The C-suite might be changing, but our long-term vision for this core franchise is locked in. So, after the mixed headlines, management's powerful counter-narrative, and all those tough analyst questions, where do we actually stand? Well, that brings us to our final take, the next call.
So, what's the bottom line from this quarter? Well, the market was basically forced to weigh a headline accounting miss against this powerful, tangible story of record sales growth and just massive capital returns. And as that stock chart showed us, investors ultimately sided with management's cash flow narrative. The story won.
And that brings us to our verdict.
Looking ahead, we are forecasting a rebound in earnings per share next quarter, somewhere in the range of $1.25 to $1.30. This is going to be driven by the impact of all those heavy share buybacks. We expect the stock to see continued positive momentum as this capital return story plays out. And so, our rating on Corebridge Financial is outperform.
Just a reminder, this is not financial advice.